It was a high-voltage week on Wall Street, a moment when big tech's earnings collided with the accelerating momentum of artificial intelligence. From Amazon's record-breaking rebound to NVIDIA's historic $26 billion expansion deal in South Korea, markets are seeing the new face of global tech growth, one powered by chips, data, and a surprising touch of diplomacy. The tone of the week was set by a simple equation: AI demand equals real revenue. Amazon proved it. Microsoft and Apple confirmed it. And investors cheered. Yet beneath the rally, a new kind of risk is quietly building: the rise of trillion-dollar AI financing conducted off the balance sheets of the world's biggest tech firms. This is the story of how Wall Street, Seoul, and Silicon Valley are reshaping the global AI economy, at once euphoric, strategic, and deeply leveraged.
The week began with a surge of optimism as U.S. stocks opened higher, powered by stronger than expected big tech earnings. Amazon led the charge, jumping 12% after revealing that AWS, its cloud computing arm, posted its fastest growth in 3 years. The takeaway was clear: artificial intelligence is no longer a concept, it's a revenue engine. Amazon Web Services' surge reflects a wave of enterprise AI demand, where companies are paying for GPU clusters, training models, and scaling infrastructure. Apple, meanwhile, rose 2%, supported by resilient services revenue and confident guidance. Its signal to the market was subtle but important. The company's pivot towards software and digital services is insulating it from hardware volatility. Markets briefly faltered after hawkish remarks from several Fed officials, but that changed after a dovish statement by Governor Waller, who reassured investors that further rate cuts remain on the table. The result? S&P plus 0.26%, Nasdaq plus 0.61%, Dow plus 0.09%. AI-related names were the week's clear winners. Twilio plus 15%, Reddit plus 14%, Cloudflare plus 10% led the software rally. In data storage, Western Digital plus 14%, SanDisk plus 5%, Micron plus 3%, and Seagate plus 3% soared as demand for AI-ready hardware continued to accelerate. In short, Wall Street is rewarding any company that can show a credible path to AI monetization. The shift from narrative to numbers is now well underway.
As investors were digesting US earnings, another seismic event took place halfway around the world. NVIDIA CEO Jensen Huang signed a landmark $26 billion AI partnership deal in Seoul with Samsung, Hyundai, and SK Group, deploying a staggering 260,000 AI chips across South Korea. The symbolism went viral. Over dinner, Huang joked about fried chicken diplomacy, saying, "Korean investors made money from NVIDIA. I love Korean fried chicken." But behind the humor lies serious strategy. This initiative marks South Korea's transformation into a regional AI powerhouse, anchored by local infrastructure, government cooperation, and private capital. Huang's stated goal: to build sovereign AI infrastructure. AI computing systems that are local, secure, and scalable, not dependent on US or Chinese cloud providers. More than 50,000 NVIDIA GPUs will power new national AI computing centers, forming the backbone of Korea's autonomous development in the AI race. It's not just a tech story, it's geopolitics in silicon form. South Korea is positioning itself as the neutral hub between the US chip ecosystem and Asia's broader industrial network, ensuring access to compute while avoiding dependence on any single superpower.
The deal's strength lies in its corporate structure: a three-pillar alliance uniting Samsung, Hyundai, and SK Group under the NVIDIA umbrella. Samsung Electronics is building a mega AI factory housing 50,000 NVIDIA GPUs for model training and enterprise applications. At the same time, it's negotiating to supply HBM4 high-bandwidth memory chips directly to NVIDIA, moving from being a customer to a critical supplier in the AI value chain. Hyundai Motor Group plans to purchase 50,000 Blackwell processors to advance AI model training for autonomous driving, robotics, and smart manufacturing. It's also committing $3 billion with the Korean government to establish an AI-driven production ecosystem where factories learn and adapt in real time. SK Group is collaborating with NVIDIA to launch Asia's first industrial AI cloud, integrating data from energy, logistics, and factory operations. This initiative will deploy RTX Pro 6000 chips to power robotics, energy optimization, and smart factory automation. Together, these corporations are constructing more than just data centers. They're building a digital economy backbone, one where chips are as strategic as oil and AI models as valuable as machinery.
Yet behind this global boom lies a less visible trend: the quiet rise of shadow financing in the AI sector. Tech giants, eager to expand infrastructure without burdening their balance sheets, are turning to special purpose vehicles, SPVs, and joint ventures to finance massive data center builds. Analysts estimate that over $1.5 trillion in AI-related capital expenditure is now being funneled through such off-balance sheet structures. Examples include Meta, which reportedly financed $60 billion worth of new data centers via a Morgan Stanley Blue Owl SPV, Elon Musk's xAI, which raised $20 billion through an Apollo-backed leasing model to rent NVidia chips instead of purchasing them outright. The logic is straightforward: keep official debt ratios low, preserve credit ratings, and still fund exponential AI growth. But the risks are becoming harder to ignore. UBS warned this week that debt-fueled AI infrastructure could outpace regulatory oversight, comparing today's financing structures to Enron's pre-2001 model, where liabilities were hidden in off-book partnerships. In short, the AI boom is not just technical or industrial. It's financial engineering at a global scale.
So what does all of this mean for investors, policymakers, and global markets? First, the opportunities are enormous. AI hardware, chips, and data infrastructure are now the defining growth drivers of the modern economy. South Korea's transformation into an AI hub cements Asia's role in the global tech value chain, linking chip-making, automotive innovation, and industrial automation. Second, the risks are mounting. The off-balance sheet financing model now fuels both growth and fragility. Just as mortgage derivatives once magnified financial risk in 2008, AI infrastructure financing could introduce similar opacity, trillions in obligations that few analysts can fully track. Third, technological obsolescence is another threat. AI hardware cycles are brutally short. What's state-of-the-art today could be obsolete in 3 years. This creates potential write-downs for companies holding physical AI assets financed through aggressive leverage. The big picture? The AI revolution is global, euphoric, and financially complex. From fried chicken diplomacy in Seoul to trillion-dollar credit deals on Wall Street, this new era of artificial intelligence is being built not only on chips, but on confidence, cooperation, and credit. As one analyst put it this week, AI is not just technology. It's the new trade, the new diplomacy, and the new debt.